Welcome to XM.com. You're watching the Daily Market Comment for Tuesday, January 31st by Haralambos Pisuros. I'm Cristina Marujos. The US dollar traded higher against all the other major currencies on Monday and continued to gain ground against most of them today as well. It seems that traders may be liquidating some of their short positions ahead of tomorrow's FOMC decision, where the committee is broadly expected to hike by 25 basis points. Fed officials agree that interest rates should rise to above 5% and stay there for a prolonged period thereafter. However, market participants still expect a peak slightly below 5% and nearly 2/4 point cuts by the end of the year. Therefore, the accompanying statement and Fed Chair Powell's press conference may have a hawkish flavor, allowing the dollar to gain a bit more. That said, recent history has shown that market participants are willing to sell dollars aggressively when data enhances their pivot view, but they are not buying with the same excitement when economic releases surprise to the upside. So the dollar is unlikely to skyrocket, and an overly hawkish European Central Bank on Thursday, confirming expectations of more 50 basis points rate increments beyond February, could limit any dollar strength, as euro-dollar is by far the largest component of the dollar index. European equities came under selling pressure and closed in the red after data showed that Spain's inflation accelerated for the first time in 6 months, adding credence to the view that more double hikes are in store for the upcoming ECB gatherings. Combined with another acceleration in euro area's underlying inflation on Wednesday, this is likely to keep expectations of a hawkish ECB elevated and thereby allow the euro to continue drifting north. Even if euro-dollar corrects lower this week, the slide may be seen as offering a renewed buying opportunity, with a potential rebound setting the stage for a test at 111.75 in the foreseeable future. For the pair's latest uptrend to come into question, the European Central Bank may need to sound more dovish than expected on Thursday. Treasury yields rose, resulting in a red day on Wall Street. All three of its main indices slid, with the more rate-sensitive Nasdaq falling almost 2%. Both the Nasdaq and the S&P 500 are currently trading above their prior downtrend lines, so figuring out what are investors' long-term plans remains a mystery. Maybe earnings by tech giants Apple, Alphabet, and Amazon on Thursday can clear some of the fog, but with aggregate earnings for S&P 500 now expected to fall 3%, even if the absolute result still seems bad, anything pointing to a smaller decline could allow for some further recovery. Thank you for watching the Daily Market Comment here at XM.com.